What's going on, guys? It's Jimmy here, and oh boy, look out, guys. They are preparing for more banks to fail and potentially in a massive, massive way. So, first, we have to really think about here what has already happened here this year. We have already had at least five major banks fail this year. One for $5 billion, one for like 44 billion dollars, three, and these are just the ones in the US, mind you. Three of them worth over $100 billion. The top two were worth over $200 billion. Then we had a multinational bank, Credit Suisse, that was worth somewhere between 500 to $1 trillion. Okay, depending on its assets worldwide. It's hard to even keep track of how much assets that bank was worth. Now, take a look at what they're preparing for. They're preparing for more banks to fail. This is because the Fed in the US and other Feds basically worldwide continue to raise interest rates and hold interest rates higher. And remember here that every time central banks or Feds, okay, Feds basically are central banks worldwide, continue to raise interest rates, that inversely makes a lot of these big national banks makes their a lot of their safe investments like treasuries go down in value. Okay, and this is causing a lot of their losses to go deep, and it's also creating a lot of panic where we've actually seen some of these banks kind of fail because people are getting scared and pulling their money from banks, which you don't have to actually run to the bank anymore. You can simply log on your phone, withdraw the money, and poof, these banks could need billions of dollars in a matter of minutes. Okay, so take a look at what is happening here. US banks alone to raise $70 billion in debt. Notice the key word in debt. Under draft rules aiming at mitigating failures, meaning they're expecting more failures. And when the failures come, they don't want them to be as bad as they could be. So they're basically expecting more failures. And when they happen, they're going to try to make them not as painful as possible. Take a listen here. Yeah, large regional banks would have to issue roughly $70 billion in fresh debt under a new rule proposed by U.S. banking regulators as part of a broader effort to bolster the resilience of the sector after the big three lenders failed earlier this year. The proposal issued by the FDIC, the Federal Reserve, and the Office of the Comptroller of the Currency would bring banks with over $100 billion in assets. So really, only the major banks. Now they're not. I guess they're not even going to worry about the non-major banks. Those are banks with under $100 billion in assets, which still a lot of money, if you ask me. More in line with the largest Wall Street giants, which already have their own debt requirements. It follows a tumultuous spring for regional banks in which Silicon Valley Bank and two other lenders collapsed. And again, this particular article is not even counting the $5 billion bank and the 40-some billion-dollar bank that failed, forcing regulators to backstop deposits to stave off a broader panic. FDIC Chairman Martin Gruenberg argued that the crisis showed smaller banks need stricter rules too. and that requiring them to issue more long-term debt would provide an added cushion for losses. Basically saying that they don't want them to be as risky with your money. Your money. Reassure depositors and encourage investors to closely scrutinize banks' operations. Because in some cases, before this, we don't even know what the banks are doing with your money. The proposal, which is subject to industry feedback, would see banks raise their long-term debt issuance by roughly 25% or 70 billion, according to the FDIC. The agency said banks would have 3 years from the rule's adoption to meet the standard. So really, they don't even have to do this until 3 years from now. So banks can still be a little bit on the wild side, a little bit loosey-goosey with your money. If finalized, lenders will be forced to issue debt in an environment where interest rates have rapidly risen and cause these banks to go out of business and also downgrade multiple US banks here recently on growing liquidity concerns, saying higher funding costs and troubles in the commercial real estate sector will likely test the credit strength of lenders. And remember, they downgraded a whole slew of banks, all the way from the largest of the large banks to almost the whole sector. Because when the large, massive banks got downgraded, they essentially had to downgrade the cascading. It was a cascade effect because if you downgrade the high grade investment banks, you can't not downgrade the rest because you can't have mid-tier banks being as high as the top grade banks because it doesn't make sense, right? So they almost had to essentially downgrade a whole slew of banks because of that cascade effect. And this essentially led to a downgrade of a lot of banks. Yeah. And therein lies the question is that how strong is the banking sector? And it almost kind of reminded me of going back to when FDIC protection was invented. And back then, when you kind of question was how safe is the banking sector? How safe is your money versus being just under your mattress and gaining zero interest? The interesting thing is right now is that because interest rates have been raised so much, you can actually go and put your money in a money market, which is basically a high yield savings account, and actually get like 5% on your money, aka the good old days of savings accounts. Of course, you got to put it in what's called a money market account now, which is basically a high yield savings account. But you can go to Vanguard, which is a multi-billion dollar company. Vanguard's the best of the best. I'm not sponsored or anything by them. But yeah, pretty much the strongest of the strong, like Fidelity, Vanguard. And you can go there and basically get a little bit over 5% on your money because of how high interest rates are. And it's basically like a savings account. You can withdraw your money, get your money deposited back into your checking account like a day or two later. It's like an online savings account. So that is kind of the pros and the cons, because trust me, there's not many pros right now of high interest rates. Yeah. If you go to your local bank account, I don't know what local, of course, it's going to vary per bank, but the local savings accounts probably are not paying much, maybe like a percent or something like that. It's going to vary per bank. But if you go to your online savings accounts, aka money market accounts, that's where you're going to get your savings. Some people are locking in the CD rates, the 3-year and 5-year rates, which are going to be a little bit less than the 5% because you're locking in that rate. Okay, so the money market, you're going to get that higher rate because it's not locked in. where if you go to lock in that 5-year rate or something like that, it's probably going to be lower because you're locking it in for a longer time. We're not expecting interest rates to stay this high for 5 years. God help us if they do, then we're all going to be in trouble. But at this rate, the Fed keeps raising interest rates. So yeah, with the remember the average home being over $400,000 now, and the average rate at 8% now. Wow, it's really getting expensive for the average person to buy a home. The other problem is the inventory is just really, really low. You know, one home comes up for sale, and you got 20 people that want to bid against you because of the small amount of homes there. You know, this is California, the most populated state. We can also go to like Texas, another high populated state. Average rates at over 8% for the average credit score of 700 to 719. Of course, if you have a 800 and up credit score, you're going to be able to get a slightly lower rate at 7.5. Still very, very expensive. You really got to hope that these rates don't stay this high. But honestly, the Fed could raise rates again. And again, God help us all. And it's not just for mortgages, guys. Credit card interest rates are averaging 25% on average. If some people are higher than that, if you're lucky, you're lower than that. If you're doing the best thing is to pay your credit cards off every month. If you can, if you've gotten to that point, and the credit cards will actually pay you every month with rewards just for using the card. That's kind of the goal, is to get to that point if you can. But the thing here is that interest rates are really crushing America. And it's not just America, everywhere around the world. So, yeah. Let me know your thoughts here. I'll keep you up to date here with everything going on here around the world on a daily basis. If you haven't yet, click the subscribe button down below and the bell icon. Thanks for liking and sharing these videos. Click here to see what just happened to millions of Americans, or you can click here to see the light being shed on Vladimir Putin's plans. Click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.